Hello everyone, good morning, welcome back to another weekly review, and this week is mainly just going to be about preparation. I want to talk about what state the markets are in, do a little macro analysis, and then talk about a little bit of technical analysis too. But here's the economic calendar for the next week. CPI, very important this week, so if they're expecting it to rise, I'm going to talk about the CPI and what all this means. And then the days after, we have employment-related news like the claims and job openings, which I'm sure people will be taking close attention to. So I'm expecting volatility to occur in the latter part of the week. I don't think the earlier part of the week is going to have much volatility. But I might be wrong, so we'll see. What happens with my setups there, my setups there. But the expectation is it's probably going to show up in the latter part of the week. Anyways, this is a chart of the Nasdaq. Obviously, we've been in a huge consolidation for quite a while now, and it's at the point where it's gotten a bit more narrow. I'm seeing consistent, support down here at these sort of lows. What I want to see going forward this week is I'm gonna expect, I'll give it the benefit of the doubt, and I'll expect it to continue going lower. But how it trades when it runs down lower here is gonna be what I'll look at. So if we get beneath all these closes, all these daily closes, and we stay down here like we close down here again, and we continue pushing past each low, then I would be bearish. And if we just look at the bodies, we have a lot of support here. It's possible that we just come down here very quickly and then we quickly run back up. So for now though, my bias is just to run out these lows, and then I'll see how we trade once we're down here. Again, I'm reacting to what my rules tell me to do. The way I trade is I don't try and predict, okay, I think price is going to go higher today, let me go in and buy it. I'm just simply doing this because I like doing analysis. It has nothing to do with my trading, and so don't take my advice and trade off of it, because that's not what I do myself. Anyways, talking about now, getting to more of macro analysis. Oil prices rose a lot. So, in the span of a week, we ran up from where we closed last week, 35%, and $90 is kind of a stressful level. If it continues to rise, it'll be even worse. But the faster oil and the more oil rises from here, the higher the chances of recessions are. So we can handle an expensive oil. It's when everything happens so quickly that the economy needs time to kind of catch up and adjust. And whether it has that time or not is going to be, well, we're going to see based on what the data shows us going forward. So just know that oil is used for almost everything that we do. Oil is used for energy, producing a lot of things that we use every day, like food. We need oil. So if oil is more expensive, it's going to be baked into the cost of goods, and that could increase inflation, make it harder for people to spend. Now, the problem with that is if we go to a chart of the CPI. CPI has sort of stalled, and it's stopped falling, and it's risen from 1.8, and now it's going to expect it to rise to, I believe, 2.5 or 2.4. Is it? 2.5. They're expecting it to rise to 2.5. So some people are convinced that it's stopped falling, and especially with what happened with oil, is definitely not going to keep falling. And so this raises a lot of concerns because the unemployment rate has also stopped falling, and it's been rising pretty steadily, still historically low, so it's still in a good spot, but it's just been rising. So this brings concerns about growth, right? Like, it's nothing crazy where, I'm saying we're going to have a market crash. I'm not saying that. I'm not saying we're going to have a recession either. I'm just saying that right now people are very nervous and concerned because the unemployment rate is slowly rising higher, and expected to continue rising. And well, actually, let's just say, the last employment data, unemployment rate, rose to 4.4%. We expected to net 50,000 extra jobs, but we got negative 92. So $150,000 miss, and that's before revisions. Revisions, they always revise it lower, so it's probably more than this, right? Now, I'm not saying that this one piece of report is evidence that we're gonna have problems. This is just one report. We have to look at the bigger picture and multiple reports. So we still have a long way to go before we really need to be sounding the alarm. But people are raising concerns because the trend is that the unemployment's going up and putting stress on the labor market, which raises concerns for growth, while inflation is also being pressured to go higher, which means people have, and 70% of the US GDP is based on consumption. So if people have a hard time spending because things are more expensive and they don't have the jobs that they used to have, then that puts a lot of stress on the economy, and essentially we could find ourselves in a big credit event. If what I'm doing to pay more attention to this is mainly looking at the credit spreads, and the credit spreads is just I wrote in my notes here, primary market-wide fear gauge for credit. All right, so this is basically the difference between safe treasury bonds that the U.S. Reserve, the United States, issues, and junk corporate bonds. So this would be like startups, AI startups, maybe like just corporate bonds that pay a high interest rate that have risk. And this is just basically the difference between the average yield you get for risky corporate bonds and safe treasury bonds. So you can see here it's around 3%. Nothing crazy is going on, nothing out of normal. But whenever there's stress, so last year during February, March 2025, I don't remember exactly what happened, but it rose and there was a correction. During COVID, it rose a lot. Typically, when it rises by 500 basis points, which means 5%, or goes above that, is when you usually have some sort of stress events. And every time we've had major stress events, like in 2022, where we had a market trend lower, it's always risen. So this is what I'd be watching. I'd be watching for it to start to pick up if we do indeed get a sort of credit event. Another kind of thing to show you that people are worried about this, not just me, is look at private equity funds like like BlackRock. BlackRock, every quarter, it's people inside its hedge funds. They have a limit on how much they can withdraw, so it's 5% every quarter, and sometimes they allow over 5%. But some people, one guy tried to do over 5%. It was 9.3%. He tried to withdraw from, I believe it was a $26 billion total account, and they didn't let him. So they told him no. And when people try and remove money like this at such a big rate, like who needs $2 billion, to be taken out of it? They're only doing this because they're scared of what could come, so they're trying to lower their risk. They don't want to be stuck in a credit event where, similar to 2008, a lot of people go, bankrupt or whatnot. And I mean, this is essentially just the market showing that it has some fear. There's some fear in the market is all. Again, nothing where we need to sound the alarm. Like, this isn't, I'm not saying that there's going to be a crisis tomorrow or next month. I'm just saying that with everything that we've seen, there's reason to be cautious. And of course, the yield curve, this is the difference between the longer term yields and the shorter term yields. So I don't actually have, let me go to my LTF. Okay, well, I mean, never mind then. I guess I guess I didn't. I thought I had drawn a bunch of stuff on here. Anyways, it doesn't matter. If you were to drop a line on 0%, that basically means that 10-year bonds, here it's the 10-year and the 3-month yields. So 10-year yields and 3-month yields are paying the same as each other. So it's just like taking the longer term yields, let's say it's right now it's like 4.5%, and the shorter term yields, to have it over here, the US 10-year government bonds or 10-year yields, which is at 4.138, and then taking the 3 months, I don't have it on here, but you could do the 2-year, any shorter term bond, and you can see the 2-year right now is paying less than the 10-year, but that's not always the case. Sometimes the shorter term loans actually pay you more than longer term, and whenever that happens, that's usually always an indication that there's going to be that we're getting into some stress. That long-term investors are behaving in a way that makes them use precaution, so they like to go into short-term, and that's what getting out of long-term bonds, or sorry, getting into long-term bonds rather than short-term bonds. Because if I really try and explain this, when the Federal Reserve raises rates, longer term bonds pay more, so investors who want fixed income get into longer term bonds. They buy, and that pushes the yields down. While shorter term, the yields stay where they are, and no one's buying shorter term bonds, because why would you want to buy a bond that's paying a high interest and then have it expire in 2 years? When interest rates are low, you can buy shorter term bonds. It'll expire in 2 years. Maybe in 2 years the rates will be higher. You get in. If it's not higher, then it's not going to be much of a difference. But understand that the rates were near 0% for a very long time. So when COVID brought the rates from like 0% to what was it, like 5, almost 6%, a lot of investors got into fixed income at a longer term, and that pushed longer term rates lower than the shorter term rates. And what happens, the unwinding of this process almost always results in some sort of small crisis or big crisis. You see every single time we went beneath this line, and the key is when we start to invert, not always when you go above it, but when we really start to get away from it and invert, like November 2007, we were all the way up here above the 0% line when the GFC hit. There's the 2000 and 2001 dot-com bust. This over here was the Gulf War in 1990. You have the stagflation, ugly stuff in the 70s, all of this stuff. More recently, you have COVID. Now, I'm not saying that something is going to happen, alright? But it's just, in history, what's always something is going on whenever we go beneath this 0% line. And right now, with everything I just said, there's obviously reason to believe that something could happen, something could break, and that would cause this to widen even faster. So, it's not widening extremely fast like it was, in 2007 or whatnot. It was very choppy, and it's still a little bit choppy. Like, I feel like the market is really just uncertain right now. And there's just so many risks, that trading needs to be, we need to be very careful. Basically, this coming week, anything could happen at any time, and things could get pretty crazy. But it is also a very exciting time to trade. So, I am excited to continue trading. It's, I guess there's nothing really much to talk about. But yeah, thank you very much for watching. I hope everybody has a good day, and we'll see you next week.